All right, starting to see our participants fill in. Very nice on the bottom. That's good. Good deal, everybody. So we'll get everybody in from the waiting room, and Tony will get them all checked in. Rich Kimball with Cross Country Mortgage and the Kimball team here. We are super excited about this program that we have for you guys today. We'll give it a minute or two to let everybody else in. Little bit different program because we're giving it via Zoom. So that's good. When we tested this out, our underwriter Jack had his T-shirt on. Now he's all dressed up for us. So we looking good, Jack. So looking good. Cool. We'll get everybody in here. Excuse me.
Benefits of working from home.
Yeah, there you go. I know one of the other things I've been working on for a future webinar, we're going to do the 2021 housing forecast. So I'll be working on that this weekend, and you guys that are here on time will get a little bit of a preview in the fact that we will be putting an email out about that. And then we're going to have a program in February about how to work your database very, very cheaply. So with some software ideas we have and some stuff. So this one's exciting today because we get to talk about non-traditional lending, which I think is underused. And I know Jack will probably agree with me. It's underused likely because people just don't know these options are available. And I always encourage the agents that work with me, if your buyer gets a declination somewhere else, come see us. We're really good at what I call rescue loans, where we can figure out a way to do something either through knowing the guidelines a little bit better, maybe having less overlays. Overlays is something in our business that's extra rules that a bank or a credit union might put over and above their guidelines. As an example, FHA lends down to a 500 credit score. Most banks have a minimum credit score for FHA in the 600s. Cross Country will lend down to a 500 credit score because we sell directly to FHA. That is a pure example of having no overlays or no additional or extra rules. So with that being said, I am going to get our program kicked off here. I think we gave everybody time to come in. Jack Katowski is been a good friend and underwriter and somebody who's helped us quite a bit with our non-QM needs. Non-QM, real quick, is, excuse me, stands for non-qualified mortgage. And essentially, after Dodd-Frank, really any mortgage that fell outside of Fannie Mae, Freddie Mac, or FHA was considered a non-qualified mortgage. Now, under that umbrella, there are a lot of different programs, and I'm not going to go over them there because otherwise there's no reason for Jack to be here. So we're going to have Jack introduce himself and then kick us over to the PowerPoint. Before we do that, there is a chat box in here, and I'm going to be reading questions out of the chat box. And so if you guys go ahead and ask them as the program's progressing, and don't be afraid to ask anything. If you don't want your name mentioned when you ask it, just make a note in there and I won't mention who it was. But truly, the only bad questions are the ones that are not asked. So with that, I'm going to turn it over to Jack and let you take controls of the screen as well.
Great. Thank you very much. Hi, everybody. As I'm going through stuff, Rich is obviously going to jump in and answer things as well. Don't hesitate to ask questions as we go through things because it's a lot easier to do it when it's on top of your mind. And if you're thinking it, somebody else probably is too. So no question is a silly question. So feel free to ask away. With that, I am going to share my screen. Can everybody see that?
Nope, not yet.
Okay, let me go to.
See, Jack, we should. Oh, there you go.
There we go.
Ta-da.
All right. So obviously the last year has been an extremely busy year for everyone doing purchases as well as mortgages. So that being said, what's the market look like going forward? You know, these non-QM loans, they're really kind of a hybrid of something that's been around for 30 years, give or take. It's really something that's very underutilized, as Rich had mentioned, and something that you should really add to your book of business, because it's going to help you make more money as well as get more referrals. So that being said, we're going to make our way through a little PowerPoint presentation. I'll give you some input on some of the programs as we go, but don't hesitate to ask questions as we go, as we mentioned. So an introduction to this is, you want to work with Rich and his team because really it's a one-stop shop. A lot of people focus on either FHA loans, period, conventional loans, period, jumbo loans, period, fix and flips, period, investors, period. Here you're going to get everything. What does portfolio mean exactly? That means something that doesn't fit the regular agency type of guidelines, something that fits outside the box. We're going to show you how portfolio loans can help you close more loans, as well as where you can find them. So just to give you an idea, for the normal mix of business that's out there today, 80% would be straight down the fairway type of loans, which would be conventional FHA loans, government type of loans. 20% of the portfolio products are non-traditional loans or non-QM loans, are something that's probably going to be very useful to you going forward. So that being said, we're going to give you an idea of what these loans look like over the years. So if you go back to 2006, right before the crash, the average borrower of or the average credit score of those borrowers was about 580. Today, that average score is over 680. So if you think to your mindset, a conventional borrower will fit with a 660, possibly even a lower credit score. So these loans and these borrowers are actually strong borrowers. Back in 2006, there was no income required. You could have done just basically a no income, no asset type of loan. Today, we're actually verifying income in some capacity. I'll get to that in a little bit. Down payment, back in 2006, you necessarily did not need one. Today, you need at least 10% down. And you can see there's a much more oversight and regulation than there were or was back in 2006.
And I just want to qualify that that's 10% down for these types of programs.
Correct.
So what Jack was talking about back in 06, when the programs kind of ran us into the housing bubble, it's because buyers didn't have any skin in the game, no money down, 80/20s, 80/10/10. I mean, there was 105s, all kinds of craziness. But under today's guidelines, skin in the game means at least 10%. So
exactly. So why does this matter to you? Now, this is using an example of really more of the jumbo space, which these loans tend to be larger than your average loans anyway. But, for an example, you close 3 more deals a year and you can potentially increase your commission by $54,000. So I'm going to show you how that could potentially come into play, in your, portfolio and your product mix.
Yeah,
so,
and to that end, Jack, sorry, Jack, I say to that end, sorry, I didn't mean to cut you off on there.
No.
I was going to say there, and it's fine. You can go to the next slide. We actually, one of our active clients in one of these products is actually a dentist right now. So, I mean, we have, a dentist is not buying a small house. He's not buying a starter home. So Jack's 100% accurate. These are generally going to be bigger purchase prices.
Exactly. So I'm going to give you some examples of loans that would fit, or borrowers that would fit, to buy homes that you might not necessarily be able to qualify through a traditional source. So self-employed and 1099 borrowers are a perfect example. So a quick scenario, self-employed buyer makes $200,000 a year, score 758, writes off 75% of his income. He's left with $50,000 to try and qualify. He's trying to buy a home and get a $750,000 loan with $50,000 income. He's not going to qualify. But because of a bank statement loan, that can qualify. And basically to give you an idea of how that works is we're not looking at tax returns. We're not looking at income. We're going to qualify the borrower off of their revenues or their deposits through either their business accounts or through their personal accounts. I won't get into all the details, but basically you're just using the revenue versus what they claim on their tax returns. Does anybody have any questions or want to talk further about it before we go on?
Yeah, I do. The one thing too, So we're in a pandemic, but obviously I think a lot of self-employed people were really hindered when their businesses were shut down in March and April and May and June. And now what we're going to see is a lot of tax returns that are going to get filed that don't represent what their income was in 2019. Fannie Mae is an example. Freddie Mac conventionally, they look at that, number one is declining income, which they don't like. And number two, they're not even going to consider 2019 if 2020 is less. So the issue there is I think we'll see a bigger need for this product because of the way the tax returns are going to look for the self-employed in 2020. So the bank statement loan may be a better option for somebody who honestly just took it on the chin like a lot of business owners did.
Absolutely. And we'll
And
get,
and Jack, we do have a question that came in.
oh,
So
great.
I do have Andy. Andy's asking, does the borrower need to be self-employed for 2 years
Yes,
for
they
bank
do.
statements?
Yes, they do.
Great question,
So
Andy. Thank you.
they can't have switched from, even if they're a company and were W-2 before and now they're 1099, they would still have to be in that 1099 role for at least 2 years to use the bank statement program. So
Cool.
any other questions on that?
So far, so good.
Okay, so I'm going to give you an idea just on loans on these types of borrowers. So typically, you're going to see a lot larger loans because typically self-employed borrowers have more assets. They have been around for a while. They may already own a home, buying something else. You're going to see bigger loans in this. And that's one of the things where you saw the increase your commissions of potentially 540,000. These loan amounts go up to $3 million. They go as high as 90% loan to value with 10% down. So these are great loans. Don't pass up on them. So let's take a look at this one. Obviously, back in 2007, 2008, and the years to follow, foreclosures became a larger part of the economy. And even though you don't hear as much about them, they still are there. So let's just say you have a borrower now who, had a recent, housing event. So we're going to go over the quick scenario. Last week, we closed on a $1.3 million home for a family that was turned down by 2 other lenders due to a foreclosure that occurred 2 years ago. Obviously, FHA has reduced guidelines even from conventional guidelines, which are even much more reduced than jumbo guidelines. So in this type of scenario, obviously in the city of Chicago, some of the west suburbs, you have a lot of jumbo homes or properties. So that being said, if you're 2 years or greater, we do have an option for somebody who's looking into, something that would be in the jumbo space that wouldn't necessarily go on an FHA basis. Does anybody have any questions then on that?
So far, so good, Jack.
Okay, we'll go on to the next one. So this one here is an asset qualifier program. So this one, we got a borrower who recently sold their multi-million-dollar business. Started a new business less than 2 years ago. When she tried to qualify for a loan, it was rejected since she didn't have long enough self-employment history, because you're going to be required to have 2 years either for a traditional agency type of loan or even the non-QM space. Even on the bank statement program, as we mentioned, you're going to need to be self-employed for 2 years. So basically, your plans of moving into a new home were almost derailed. So the key of this type of program is you're actually qualifying the borrower strictly off of the assets that they have. So it's not looking at cash flow. It's not looking at tax returns. It's strictly just looking at the assets they currently have in their possession. Those could be either liquid or retirement accounts, or a blend of the two of them. But retirement accounts, you would have to have liquid assets as well.
So. Yeah, I've got a good example too. We had a situation last year where we had a doctor that was referred to us. He had been turned down by a couple different banks, and the scenario was he had gotten divorced, and he was going to have a pretty substantial alimony and child support payment. And when you included that plus some student loans that he had still hanging out, we were looking, I think the best case scenario was like a 67% debt to income ratio. Well, as part and parcel to the divorce, he's got to find a new home. So he's out looking for a home. He's got this pretty significant alimony and child support payment. We were able to use the money that he has in the bank remaining from the divorce and we were able to actually supplement the income we were missing by using the asset depletion program. So yeah, it was great because he qualified for that new home where everybody else was telling him that he wasn't going to be able to do it. And here you got it. And here you got a guy that was literally looking at, like, I think ironically, I think it was a $1.3 million home. Maybe that's why I remembered it. So
Gotcha. Funny how things trigger it.
yeah.
So on to the next one.
I do have a question, Jack, that came up. So Claudia is asking, what is the interest rate for this? I'm assuming she's talking about the asset qualifier.
I mean, pricing all varies upon different credit scores as well as loan to values. They could be anywhere from the, upper 4s to 7s. It really depends on the borrower.
Absolutely. And there's one thing that I want to say about this, from that standpoint, we always like to talk to the borrowers and not let you guys discuss what the rates might be. Because, oftentimes you get people hung up about the interest rate when in actuality, we show them, okay, the difference from, let's say, 2.75 to 4.75, let's say the difference in that spread, maybe it's $12,000, just picking a number, but maybe it's $12,000 extra interest that they're going to pay because they have a higher rate of interest. However, if they had to show the income to qualify and then pay the federal taxes and the state income taxes, they might have to show enough income where their tax obligation was $38,000 or $42,000. So the choices are pay Uncle Sam in the state of Illinois $42,000 and get that nice rate, or save the tax money by being aggressive with your aggressive with your deductions, pay a little bit extra interest. It's always a cheaper option. So our team will have those conversations, and just kind of, these are business owners. They understand the math. The math dictates pay the higher interest rate, get into the home, and continue to use the advantages of what the tax code will give you to write some things off. So
Absolutely. Any other questions at this point?
so far we're good.
Okay, great. So this is probably my favorite program. This is for investment properties. So on a typical, I'll go with the scenario first and I'll get into the details a little more. So investors looking to purchase his 19th investment home. So your typical agency lender is going to allow anywhere from 5 to 10, depending on what their appetite is. His prior funding was very costly because it was hard money with high rates and fees. He was unable to qualify for mortgage using cash returns. After rental analysis was completed, he was able to qualify using the investor cash flow program. So on this program, what we're looking at is somebody who currently owns a primary home that they live in. And then this program allows somebody to have an unlimited number of financed properties, which is huge. So you have 1,000 financed properties, that's okay. It can close in an LLC, which is very desirable to a lot of investors. And it only qualifies off the rent from the subject property itself. We don't look at anything else. So, for example, if you had a condo in the city and your PITIA, so your principal, interest, tax, insurance, and association dues totaled $2,500, and your rent on the property was $2,500, it qualifies. There's nothing else to look at when it comes to qualifying on payment-wise. If the score is over 700 and your loan to value is 70% or less, we don't even need to have a qualification. So your payment could be $5,000 and your rent could only be $3,000 and it would still qualify. Investors love this program because if they were to go to a small bank, let's just say, they're going to ask them to put up their house. They're going to ask them for additional collateral. They're only going to give them typically a 12 to a 36-month term because they want to see how it's going to perform on their books. And every time they renew it, they're going to have to get another appraisal, potentially on multiple properties, and also continue to have their other assets tied up with this property. So investors love this program.
And then the other thing, Jack, if I can throw in here, so this is really important, especially for agents who want to invest in property. They are not looking at tax returns. So when I get this application, I'm not listing a job. I'm not throwing anything in the income section. I'm not giving them tax returns. I'm not asking for paycheck stubs. They are simply qualifying this loan based on the rental cash flow of the property. So the keys to this typically are good credit and assets. And because you guys, for down payment, you want to see that they have assets. And I believe, correct me if I'm wrong, Jack, they can't be gifted. You guys have to verify the assets if in a purchase scenario, correct? Which is very
Correct.
similar to Fannie Mae and Freddie Mac. They don't allow gifts for investment property. So if you have the cash and you have good credit, we don't need anything else. And again, we can close those in an LLC. So this is a program that you as a real estate agent, I know we've done these for real estate agents and certainly agents that are working with investors. This is a huge program. I did get a question to come in. Okay. Janelle, sorry about that. So Janelle asks, what is the down payment percentage for the investor cash loan program?
So it goes as little as 20% down with a 680 credit score, 25% with a 660, and 30% down with a 640 credit score.
So LLC 640 credit score. I mean, no income tax. That's pretty amazing.
Yes.
What about 2, 3s, and 4 units? How does that impact the loan to value? That's a question from Rich, the panelist.
2, 3, and 4 units are okay.
Okay.
You're just maxing 75%.
Perfect. That's awesome. I have another question that came in from Andy. He asked, can investors use this as a refinance to purchase other properties? In other words, I think, can they cash out an existing property and go buy something else?
They can. They do need to own the property for 12 months to use the new appraised value. So if they bought it, rehabbed it, they have to have it for 12 months before they can use the new value.
Terrific. And then, and I don't think Andy was asking about any kind of bridge loans because you guys don't do that type of thing, cross collateralization of property. That's something more of a commercial lender would do, which, and again, Jack's very right. If you turn to a commercial lender for this stuff, the most that they carry these things out for is 5 years. And at the end of 5 years, you're refinancing, turning over all your financials, which you don't have to do here because these are 30-year loans. And you're fixed as an option for 30 years. And Jack, we have adjustables as well, correct?
For ARMs, no, this is only on a 30-year fixed.
Oh, okay, good. All right, that's fine.
And,
I mean, that's
and,
even better.
and one of the things I can tell you is people I know who work at banks, a lot of them are trying to get their investors off their portfolios. There's a lot of fear out there right now for investors that because of the COVID stuff and them not, giving rent forgiveness, a lot of these landlords have not been making their payments. So you're potentially, and obviously with these loan modifications, you're going to see a lot of foreclosures coming in the rental market potentially. So a lot of the small banks are fearful of this and trying to steer away from this business. So this is an excellent program for these borrowers.
That's great advice, Jack. That's great. So far, I have no other questions. So on that program, great product though.
Okay, so this is just kind of a summary. So we're able to save these deals with self-employed with significant write-offs, recent credit events, only 2 years, buyers with significant assets, and investor-specific programs. Now, I can tell you with these programs, obviously, as I mentioned, that investor cash flow, the debt uses a debt service coverage to qualify is a big product, but the bank statement product is probably the biggest. We actually have seen a lot of realtors themselves who've used both of those programs. A lot of you have probably either dealt with investment properties in your past or have some desire to do it now. Even with your taxes, you write everything off that you possibly can too. So don't be fearful to even, reach out to use these programs for yourselves. Okay, so we're gonna move on. So just gonna give you an idea again of some of the criteria, what you see out in the marketplace. So even though, the primary golden goose, if you will, is your 760 borrower who's putting down 25%, can buy anything, has a great job, everything. Those are the ideal borrowers. However, for the actual population, approximately 57% of the households have a credit score under 680, and a third have a credit score under 620. So you can see there's a very large percentage of people out there that are underserved. For the self-employed, the bank statement, loans, 36% of all U.S. workers are gig workers in some capacity. So obviously they're making money, on the hustle, if you will. 57.3 million people are in the gig economy. That's a large number of people. I mean, if you look at, Chicago being the, third largest city, obviously that could potentially, fall to Houston, but regardless right now that is. So you have to figure Chicago is mainly Illinois. You're looking at over 1 million borrowers or buyers that are self-employed. And that's going to be probably just in the Chicagoland area. So there's a large number of these people who are underserved. If you take a look at the number of foreclosures since 2008, there's been over 18 million. And just in the last year alone, over 1.5 million. So a lot of these borrowers are either going to foreclosure for loss of job, a sick loved one, whatever it might be. But these buyers are constantly leaving the market and coming back in the market. So you always want to keep your options open for all of these borrowers. I think there might have been another question. I thought I saw a number pop up.
Nope, that was just some feedback from me.
Okay. Any other questions on this stuff? Probably not, I'm guessing.
Yeah, so far so good, Jack.
Okay. So what's unique to these borrowers? Rich can send this kind of slideshow out to you if you would like, but I'm going to go over the main thing, that the reason the mortgage application was rejected was debt to income ratio, which would be your bank statement, borrower potentially. We do allow for higher ratios as well. Standard is 40/50. So even on a jumbo, we'll go to 50% on the back end, which is big. Lower credit scores, insufficient down payment. Now, just because we don't allow a gift on investment properties, we do allow gifts on bank statement loans as well as the shorter seasoning. The borrower has to have at least 5% of their own funds, and they can get the rest of the gift from mom, dad, brother, whoever it might be. Not enough money reserves, income unable to be verified, and too soon after refinancing another property. Obviously the seasoning issue. So we're going to move on.
Yeah, Jack, I do have a question.
Sure.
What about people with cash on hand? You were talking about gifting, like what is that? Is there anything unique that you guys do in that world?
So we don't allow cash, obviously, for anti-money laundering purposes. So what we do have, we only have 30-day seasoning on the normal loans. On the investment properties, you do have 60-day seasoning.
Got it.
So with 30-day seasoning, let's just say you're using a bank statement loan and we're using their business bank statements to qualify, or even their personal bank statements through their checking account to qualify. One of the things you could do, if they have cash on hand, they could always throw that cash into a separate savings account that they have. We only require 30-day seasoning on assets. So let's just say they deposited the funds today and they got January statement February 3rd, and it showed that large deposit. We couldn't use it because it was just deposited. We'd have to source and season those funds. However, with them being deposited today, if you got February statement, say March 3rd, we could have everything else cleared without the assets. We get a copy of the statement March 3rd, get that cleared, and then you can close in the beginning of March, on that loan, because those assets would be qualified or seasoned for down payment.
Perfect.
I saw something pop up.
Yeah, we did have a question from Joe. We actually addressed this a little bit, but I just want to cover it again really quickly. Joe had asked what type of rates are these buyers getting compared to qualifying conforming, and in the example that we gave before, I think Jack, and on these 30-year fixed products, anywhere from 4.5 on the low side, and certainly on the investor thing, you might be up in the 7s, correct? 6s, 7s.
Well, I can tell you, if it really depends on the borrower. Even like on a bank statement loan, a good enough credit score, a low enough loan to value, if the borrower is willing to pay their own closing costs, you get a rate in the mid 3s.
Perfect.
It really depends. And one of the things I wanted to, a lot of buyers get hung up on rate. And, the easiest way to explain to somebody, they've already been to Bank of America and Chase and their credit union, and everybody's told them no. And then they come because everybody's told them no. And Rich, he finds a solution for them. and says, all right, well, we're able to get this loan done for you. And your rate is, well, I'm going to throw something out, is 8.5%. Well, that's crazy. Well, crazy.
Right.
I'm not paying that. Okay. Why is the rate so high? Well, you don't qualify for anything else. So I'm giving you an option. You can pay this. Your issue will fall off a year from now. I'll be able to take you FHA, or if you, file your tax returns and you qualify, I can get you on a regular conventional loan or a traditional jumbo type of loan, and we'll refinance you then. So you're going to pay a smaller, or a slightly higher interest rate, say for 12 months, and we're going to get you into a loan. So it's high compared to when you don't qualify for something now. Just always remember that rate is not necessarily always the pain point. It's getting into the house. So I have a couple questions pop up.
Yeah, and actually, and we talked about it before, but payment's important, because ultimately, when you write that check, nothing on that check says that you're paying a 5% mortgage. It says the payments are $1,829, and that's the payment that you're writing. And again, for investors or for the self-employed, having to show enough income and pay federal and state income tax versus paying a little bit extra in the rate typically ends up about, the cost of the interest is it's usually less than 25 or 20% of the taxes. So you save just a huge amount of money. Yes, you're paying a little more in rate, but the tax savings is ridiculous. So we did have a couple other questions that came in. Let's see here. This is a great question. Jack Janelle asks, and thank you for the question, Janelle, are bank statement loans only for self-employed individuals?
Self-employed or 1099 individuals.
Okay.
So we're going to use obviously a W-2 borrower. They get a W-2 there. There's not a lot of write-offs they can take. If you have a married couple and one is self-employed and the other one is W-2'd, so you can qualify using both incomes. We actually get a 4506 on their W-2 income. And then we obviously use the bank statements or the revenues to qualify the self-employed borrower. The key on that is the self-employed borrower has to make up at least 30% of the income after it's calculated.
Perfect. That's pretty aggressive. That's great. Let's see here. One of our participants asked if they can get a recording. Andy, Tony will send out a recording to all of those that attended. And then Joe just mentioned he got in late about the interest rate question. Not a problem. Like I said earlier, and Joe, you missed this. The only questions that are bad ones are the ones that aren't asked. So I'm okay if you got to ask something else. It's totally fine there. And let's see, we got that on the rates. We talked about the bank statements, and I am caught up on questions, Jack.
Great. Okay. So where can you find these? So I'm sure when you really think about your book of business going back even 5 years ago, you may have had a borrower that didn't want to sell their home because they felt they couldn't get a new home. I mean, that's outside of somebody who was turned down, somebody who was self-employed, be like, yeah, I really make $250,000 a year, but after my write-offs, I make $30,000 a year. So I'm not going to qualify. Obviously this person can now sell their house and buy something new that they really want to, with having these different types of income, sources to qualify off of. Builders and developers, even though you're typically working with buyers that are coming directly to you that you're finding, builders and developers have turn downs all the time too. So if you can go and obviously get, some of the turn downs, have Rich help you, the builder will pay you obviously a realtor commission, based on that as well. So don't, pass up that avenue. For some of the bank statement business, accountants, CPAs, financial planners, great source. If you take, if you take the area that you're located in and you look up, accountants, CPAs, financial planners, especially being tax time coming up right now, and you find 50 or 100 of them in your area, and you just blitz out, hey, would you mind if I stopped in, before you get too busy, and I'd like to sit down and talk with you for 5 or 10 minutes and just let you know that I can help buyers because I have very aggressive financing options for them to be able to help them get into a home, and you're going to be doing their tax returns. So anybody that that makes a lot of or has a lot of revenue that writes everything off, I have something available for them. Bankruptcy attorneys, foreclosure attorneys, great place to find somebody who's had some issues in the past. Hey, I know your client had, if anybody's had something over 2 years ago, that might want to buy something. I can help them get into a home. Social media, of course, everybody's on that these days. So any questions on potentially how to maybe find some additional business in these avenues? Rich will be there
Yeah.
for you as well, of course. But literally just finding emails and finding 100 of them in your area, sending out an email. Hey, I'm a realtor that, specializes in self-employed borrowers, in blitzing 100 CPAs, accountants, financial planners every Monday morning, just sending them something out. Hey, if you've got 10 minutes of your time, I'd love to stop in and chat with you and see if I can help, some of your clients buy a home.
Yeah, and I mean, that's great advice, certainly. And it's great advice, and I like Jack's approach. I mean, at minimum, if you don't want to send 100 people, talk to your own accountant and your own financial planners, because we get a lot of business through the year. The accountants are always getting the questions from their self-employed people that, hey, you did such a great job on my taxes, I can't get a mortgage. Like, that is a conversation that is happening with the CPA, probably even today as we speak. So these CPAs and accountants definitely hear the pain points. And if you're connected with them somehow and they could say, you know what, I have somebody that might help you, in spite of the fact that I saved you tens of thousands of dollars in income taxes, I have somebody that might be able to help you accomplish that dream of buying a home. And again, you're the real estate agent that specializes that. The other piece is financial planners, and why it's really important to them is because typically, if they can't get the mortgage, they're just going to go pay cash. Well, that's a nightmare for the financial planner, because that means they're actually losing assets under management. These guys get paid based on the amount of assets under management. So somebody decides, I got to buy $800,000 cash because Chase just turned me down, or my bank, or whoever. These financial planners will love this type of information. And ultimately, if you are the realtor, at least in this little space, like you say, hey, I'm the agent that specializes in tough to finance deals, then you turn it over to us. We'll take care of the financing. You get to take the buyer out because you found in the money where nobody else could have found in the money. It's really a win-win for all three parties.
Absolutely. I didn't see any questions pop up. Am I right?
Yeah, I think we're good there, Jack.
Okay. So, actually, I think something's popping up.
Oh, yeah, we got a long one. Okay, good. Let's see. Teresa, let's see here. I'm going to kind of skim through this just to get to, I think. Oh, okay, good. So just Teresa had asked, basically, she had just said it's good timing. She's actually out with an investor right now showing properties, and she thinks our program is better than what the client was approved for. So, excuse me, she's going to reach back out to us. And then and thank you, Jack, for a tremendous presentation, and just for me, my big smile. So
Oh, of course.
yeah, there you go. Thank you, Teresa. Here's another question from Shonda. Shonda had asked, is self-employed, can they use a business line of credit for down payment and fees? It's a great question.
Unfortunately, they can't. It does have to be the borrower's own funds. They can't be borrowed funds. So if you had somebody, let's just say, that was looking to do this, if they took a draw off their line of credit and deposited into a separate account, that we weren't using, again, you could potentially use that a couple months down the road, but we wouldn't want to see that deposit into their account. So, I mean,
Yes. So
it's a
Jack, I mean,
waiting game.
And Jack covered this essentially on that line of credit, on that business line. They're just going to deposit that money and season that in. On the bank statement program, though, you may want to actually put it in a different account, not the actual statements that are being used for the underwriter's analysis of the income. So, and the fact of the matter is, with a 30-day seasoning, it's really, really slick in my opinion, because Jack, if we're under a 60-day contract, they could literally season that money while they're under contract. Is that accurate?
Uh, yes, we just can't see that deposit going anywhere. So we can't see that deposit coming off of a business line. If there's anything that shows it, and it would get caught. So they just have to make sure that they know that they're not putting it into something that's going to be seen for that
Got it.
deposit.
Got it. And then let's see here. Great question from Onia. Onia asks, what is the minimum amount that can be borrowed under these programs? What's your minimum loan amount?
So on the bank statement program is $150,000. On the short seasoning for, say, a BK foreclosure of only 2 years, that's using full income documentation, has a minimum loan amount of $125,000. The investor cash flow using the debt service coverage ratio, that can go as low as $75,000. It gets a little tricky when they're small like that. 100,000 is more desirable, but it does go down to 75,000. And then there's an alternative, to jumbo lending that starts at $250,000. But that can also fall into the shorter seasoning one, just a slightly higher interest rate. So that again can go down to 125,000.
Cool. Thanks. Thank you, Onia, for that. Tawana asked, what about an individual that has a bankruptcy? We'll cover that part of the question first.
Okay. So for a bankruptcy, again, the 2-year seasoning that we're looking at would be on a Chapter 7 from the discharge date. So on the shorter seasoning, we require only 2 years on that full doc program. All the other programs at this time require 4 years. On a Chapter 13, we're actually looking at the filing dates because it's a repayment plan. So it had to have been filed over 2 years ago, has to have been paid on time, and has to have been discharged. On the other ones for 4 years, it has to have obviously been filed over 4 years ago, paid on time, and discharged.
So on the discharge, they could have a bankruptcy. They just have to have 2 years in between the actual filing date and when you'll do it?
Correct. It has to be discharged, okay, as agreed, and filed over 2 years ago on a full doc basis.
Okay. On a 13. Okay, perfect. And Jack, and we could probably cover something here. These guidelines a little different than they were maybe February of last year?
Oh, completely different.
Yeah, let's cover that. That's important.
And obviously they will open up, more again. So if you go back to February last year, it only required 2 years seasoning on the bank statement program, on the jumbo program. We did scores down to a 500 credit score, a date of a foreclosure, a date of a bankruptcy, mortgage lates. There was a lot more product available, and until the appetite in Wall Street increases for this type of product, it's going to remain at this. But of the loans that were actually done back in February, the products that are out today still actually make up about 90% of the loans that were done in February. So you're not missing out on a lot, because a lot of those borrowers say they had a 500 credit score and had a bankruptcy 6 months ago. Will they, at that point, you needed 25% down at least on that. Would they have 25% to put down?
Yeah, and to that point, so the pandemic changed a lot of things for lending all the way around, certainly impacted, I think, the non-QM space quite a bit. To that point, if you get something 6 months from now and where the economy is in a better position, pandemic is starting to wane, don't hesitate to reach out, because at that point our guidelines may have changed. So again, these are today's guidelines, but again, 6 to 12 months down the road, we may see some more things that would be considered aggressive under today's current guidelines. Tawana also asked a great question. Jack, what is, how are you treating student loans? So we got $100,000 in deferred student loans. What does that look like in a payment?
So if the student loan if it's deferred greater than 12 months beyond our funding date, we don't count it at all. Again, it has to be deferred over 12 months beyond the funding date, not the closing date. Typically on a purchase would be the same, but so 1 year beyond and you're okay. If not, and there's not a payment showing, we're going to use 1% of the outstanding amount in the borrower's debt to income ratio in the liability section.
Now, if they have a payment showing, you will use the payment showing, even though the payment might be economically reduced.
But potentially, more than likely, yes.
Perfect.
If
yeah,
you
that's
$100,000
great.
and you had a $10 payment, we might want to see something on it. But more than likely, on that you're going to have a bigger payment than something minimal like that.
Right, but FHA is not. I mean, FHA, their guideline right now is it's 1% across the board. So being able to either A, defer them entirely is huge if they're deferred out, or ignore them entirely if they're deferred out for 12 months, and or use the economic payment. The only way right now today we could use the economically reduced payment is through Fannie Mae. They're the only ones that have kind of loosened that up a little bit. So the fact that you guys are able to open this up, this is fantastic. So Tawana, thank you very much for that question. That was great information. We have another question coming in from Shonda. Yeah, that's interesting. Can this be used to buy a portfolio or more than one property at a time? I think I have I think I know what your answer is going to be, but go ahead.
Yeah, unfortunately, no. We only do individual loans at a given time. We can't do a portfolio.
So regrettably, if you're buying a portfolio of 10, we would end up doing 10 loans.
Right. We only allow potentially up to 5 loans or
Okay.
$1 million cumulative for any given borrower at one time. So obviously, California, you have average loan amounts about $1 million. We don't have that here. So hitting $3 million is pretty tough for a cumulative on 5 loans here.
So, and ultimately though, I mean, while we have this product that we use with Jack, we do have another product. So if we go through 5 with Jack, we may have another spot for the other 5 too. So it still may be able to something that we could cover. So again, regret individual loans, which obviously gets pricier to close for the client though.
Sure. And I'd like to, just kind of go over one of the things, just so you kind of have an idea of how the bank statement program works. I don't know if anybody would, like to hear that, but I think it's something that might be good for your mindset. So if you got a borrower who owns, say, a small manufacturing company, and on their tax returns, it shows that they make, because of write-offs, they make $60,000 a year. But in their business, they're 100% owner of the business. They have one location and they've got, 7 employees. And their total revenues for the business, their sales, it's not their income, is $1 million. And we determined that their expenses on that type of business would be 70%. So in that type of scenario, we're just using, say, 12 months to qualify. So even though the revenues were $1 million, we're using 70% expenses, which leaves $300,000 left over. We divide that by 12 months. That gives your borrower $25,000 a month to qualify off of versus the $5,000 a month they have claimed on their tax returns. That's kind of how that program works, just so you know, have an idea in your mind, what we're looking at.
That is some sexy buying power, by the way.
Yes.
40% of $25,000. That's a pretty big payment. So I see 7-figure sales from some of my people on here. So this is good. To want to ask a question, when we have a buyer that may qualify for several different products, do we just have you all work to see which fits the best? And that would be yes. Send it over to us. Somebody on myself or somebody on our team is going to evaluate it and see really what makes sense. A lot of times as we dig into the application, the bank statement might make sense for this one. The asset depletion might be a better scenario there. On an investment property, I love the debt service product. I mean, I just think it keeps things so simple and so clean. It's name, social, address. What do they have in the bank? They have good credit, and we're going. All the income stuff's out the window with the exception of the subject property. So let's see here. We have Onia asked if there's anyone in particular on your team that works these types of loans. If you guys haven't noticed, we do have Priscilla here. Part of the reason she's here is because I do have a 1 o'clock, and in case there was something that came up, she was going to be able to be here. Most of our team has worked the bank statement products. Priscilla's got a little bit more experience in some of the other products, but she might be picked today, certainly to be our resident expert, but we try to spread that wealth. But she would be the person to go to if you're looking for somebody outside of me. Let's see here. Okay, perfect. So that's that. And so that's to answer your question, Onia, either her or I specifically on the bank statement program. The DCR, maybe myself. And I think David's done some of those too. So I think we're good on questions. We're caught up on that, Jack.
Okay. That's
Cool.
pretty much kind of the end of the slideshow, and you get a bonus there at the end of Rich.
Some more smiling.
Yes. Yes.
That's good. That's good. So, I mean, this is, ultimately for you guys, what first of all, the first and foremost place that you're going to find this stuff is going to be, your turn downs, like folks, specifically folks that have a larger down payment. If they're getting turned down, I would point them in our direction, because that's where some of these programs kind of fall into. So point them in our direction and we'll see what we can do. The self-employed, the investors, send them to us. We'll see if they fit in some of these unique options, number one. And then this obviously gives you a way, aside from the turn downs, to get some business. But Jack gave some great examples: financial planners, bankruptcy attorneys, divorce attorneys. There's some great places to go do that, go do some marketing. And then the other thing, certainly, there we go. The other piece certainly is we can create some flyers for you guys. So if you wanted to take something and maybe post it on social media, like, hey, if you're self-employed and are having a problem getting some financing to buy your next home or your move up home, call us, check into us. So we would definitely be able to create that, some of that marketing, and Tony on my team is phenomenal for that. So certainly reach out to her or I. Ultimately, she'll be the one that's going to end up putting some of the marketing piece together. You don't want me putting marketing stuff together, so you definitely want Tony doing that. So it would not turn out well. So let's see, we have coming up, we were talking about, we will be doing a program on, I ideally want to do it towards the end of the month. We'll be talking about really our forecast for housing through Barry Habib and the mortgage MBS highway. We've been following Barry's advice for 20 plus years, and he's almost always spot on. He's got some interest rate forecasts that I think you guys will be interested in. Why we think that 1.6 trillion in mortgages is a real number, and why I think you guys are going to have a lot more business coming up, and then some strategies that we have to help you guys get your offers approved. So we're going to be talking about that in about 2 weeks. In February, we've got a program coming up where we're going to introduce you to a very, very inexpensive software that will market your database on a monthly basis for you. And literally, we've been using it for a while, and we've had some great success for it. So we'll be doing that. With that, if I don't have any more questions, we will bid everybody adieu. Tony will get everybody who registered a copy of the recording. And Jack, thank you very much for your time. Priscilla, thanks for backing me up. It looks like we got out with 8 minutes to spare, so that's good. And we're getting some thank yous through the feed, so we certainly appreciate that. Tony, thank you very much for putting this together. Couldn't do this at the pace we do it without you, so we're very blessed there. And guys, have a blessed day and take care.
Great. Thanks, everybody.